Hi there, welcome to Kneppy Invest. Over the past 3 or 4 months, I have done a plethora of financial year 22 result videos, and I planned on continuing this series or that series for a while yet. However, over the last few days, I've decided to subtly change or shift the way I do these videos. And the first thing I'm doing is changing the name from financial year 22 results to Kneppy's analysis. And one of the reasons I just wanted to change or subtly change these videos is to have less emphasis on the financial year 22 results and talk about other things about these companies that might intrigue me or might intrigue you. And the first company I'll be featuring in this particular series is Fenix Resources. This is an iron ore mining company, a small iron ore mining company that has a really high dividend yield. For full disclosure purposes, I am a shareholder of Fenix. I have been a shareholder of this company for the last 2 years, and I plan to be a shareholder of this company for the foreseeable future. The only reason I might sell out of my Fenix shares is if we do see the iron ore prices fall considerably from where they are now. And that's a possibility, so I always keep my eye on iron ore prices. The main reason I am a Fenix shareholder and plan to continue being a Fenix shareholder is simply because of their dividends. I'll talk about the dividends later in the video. In my opinion, understanding the quality of a company is a highly important thing most investors should do. And fortunately, determining the quality of a company is going to be highly subjective. And that is really important because what you might consider a high quality company, I might consider that company to be low quality. And I treat high quality companies a lot different than low quality companies. For high quality companies, it's all about value. Do I see value in that company right now? For low quality companies, it's all about underlying sentiment in the company, or for mining companies, all about the underlying sentiment in the commodity itself. Now, in my opinion, all mining companies, including Fenix, are low quality companies. And the simple reason behind that thought is because they are price takers. So Fenix and Fenix future success is highly dependent on iron ore prices. And management of Fenix have no say or very little say in how much they sell their iron ore for. And that is why I consider every single mining company to be a low quality company, including BHP, Rio Tinto, and Fortescue. The first thing about Fenix we probably have to discuss is their project. And they do have their mine, the iron ore mine in Western Australia, called Iron Ridge, not to be confused with Iron Bridge, which is a Fortescue iron ore project 150 kilometres south of Port Hedland. Iron Ridge is about a 450 kilometre drive to Geraldton, which is where Fenix ships out their iron ore. Recently, Fenix purchased a haulage company to decrease their cost, which is very important because when you compare Fortescue costs of getting the iron ore out of the ground to Fenix costs are much higher than Fortescue. And that's very important because if iron ore prices do fall to say $50, $60 a ton, Fenix would not be profitable, and Fortescue, BHP, and Rio Tinto would be profitable. Now, Fenix have been mining iron ore out of Iron Ridge for about or just under 2 years, and this particular project has created or generated $127 million of cash to date. Now, the next most important thing when discussing this particular project is mine life, and I'll talk about that later in the video. Now onto the financial year 22 results for Fenix, and at a share price of 24.5 cents, which was the share price at the end of trading on the 9th of December. Actually, I'm recording this video just after trading has finished on the 12th of December, and the share price is actually 25 cents. But at 24.5 cents, the markup of this company was $143 million. Now, I tend to look at enterprise value for companies like Fenix, and I'll talk about why in the next slide. Now onto the financial year 22 numbers. And when you compare the markup to these numbers, does seem to be something amiss because revenue was $249.2 million, but when you look at profit, $50.7 million, which means the PE ratio of this company is less than 3. Operating cash flow, $62.3 million, which means the price operating cash flow is just above 2, and the free cash flow So you go from operating cash flow to free cash flow by minusing the capital expenditure is 55.6 million. So just by looking at profit, operating cash flow, and free cash flow, you might assume that the valuation of this company is really, really low. But there might be some reasons behind that, and I might address those reasons later in the video. Or I might not. It depends if I remember to address it. Anyway, now the market cap of Fenix is $143 million. And it's very important to note that right now, or at the end of financial year 22, not right now, because in fact, cash is going to be a little bit lower than 101.7 because I actually did pay out a fair bit of money in dividends. By the end of financial year 22, they had $101.7 million of cash and zero debt. To calculate the enterprise value, which is a true indication of how the market is valuing a company, you take the markup minus the cash, add back the debt. So enterprise value right now of Fenix is $41 million. I'll say that again, $41 million when this company produced more than that in profits, more than that in operating cash flow, and more than that in free cash flow in 1 year. In this particular slide, I'm going to compare Fenix to Fortescue, paying particular attention to the iron ore mined from each company and also comparing the cash cost or the C1 cash cost, which is sort of the amount of money the company has to spend to extract the iron ore out of the ground. It's very important to know or compare the cash cost for each individual company. And also, it's good to know how bigger one company or smaller one company is compared to another. Now, for Fenix, it's all about, in regards to iron ore mined, it's all about 1,000 wet metric tons. And for financial year 22, it was 1,267,000 wet metric tons mined. For Fortescue, we're talking about millions wet metric tons. And for financial year 22, that was 228.8 million wet metric tons. So for Fenix, it's thousands. For Fortescue, it's millions. So that should show you the difference in size between Fortescue and Fenix. The next more important thing, or most important thing, is to look at C1 cash cost. Now, for Fenix, it is shown in Australian dollars. For Fortescue, this is shown in American dollars, but there is a big difference between the two. For Fenix in financial year 22, it was 88.8 Australian dollars, while for Fortescue in financial year 22, it was 15.9 American dollars. So to extract the iron ore out of the ground, Fenix has to pay a lot more than Fortescue when you do convert one of those numbers to the other's currency. The main reason I am a Fenix shareholder right now is the dividends. And if iron ore prices stay above $100 a ton, I think Fenix will continue to pay a fair bit of their cash flow out as dividends to their shareholders. So right now, the dividend yield is 21.4%, tax adjusted 16.8%. This is straight from CONSEC, franking 100%. The last ex-dividend date was the 1st of September. Now, they've only paid 2 dividends, one in 2021 and one in 2022. Both dividends was 5.3 cents. So I have received from Fenix 10.6 cents in dividends over the past 2 years. Now, it's very important to know how long the mine life is for Fenix. So if they continue to mine over the next 5 years and iron ore prices remain where they are right now or even higher, this company will be generating a lot of cash flow moving forward. And I'm hoping, if I maintain a holding in this company, that eventually the amount of money I received in dividends will go past my original cost to buy into Fenix. Now, Fenix is an iron ore producer, and you would think because they are solely an iron ore producer, the share price of Fenix should be highly correlated to iron ore prices. So in this particular chart, which is a weekly chart going back to the end of 2018, I've just overlaid iron ore prices on top of Fenix chart. And you can see from the end of 2018 all the way through to July 2021, there was a high correlation between iron ore prices and Fenix share price. And then as iron ore prices started to fall in the later half of 2021, that's where we started to see Fenix share price started to drop. But you'll notice over the past year, year and a half, that the share price of Fenix has remained a little bit elevated, a little bit above the iron ore prices. And the reason for that is the dividends. And in TradingView, you can adjust the share price of a company to the dividends. So let's have a look at that, because in this particular slide, the share price high for Fenix was 44 cents in June of 2021. But when you adjust for the dividends, you do get a lower price back in June, because at that point in time, they had not paid any dividends. So let's have a look at the dividend adjusted chart for Fenix Resources. And this is the dividend adjusted chart for Fenix. And what TradingView does, and probably other trading packages do, is they adjust the share price or the chart of the company in the past after the company has gone ex-dividend. So remember, Fenix has provided two 5.3-cent dividends in the last 2 years, in September 2021, September 2022, which means that TradingView has adjusted the share price down 10.6 cents in the past. Well, actually, it's 5.3 cents over the past year, and then 10.6 cents previous to September 2021. So if we go to those highs we saw in June 2021, when the share price actually did reach 45 cents, in this particular dividend adjusted chart, the share price then looks like it's only reached 31.5 cents because it's been adjusted down because of those dividends. And it's very important to know that when you do own a company and they do issue dividends, you don't only look at the capital gains, you also have to adjust the returns of that company with dividends. So for Fenix, my return at this point in time, taking away any capital gains, is 10.6 cents per share. And hopefully all that makes sense. If it doesn't make sense, what I just talked about in that previous slide, just leave something in the comments section. Now, let's go back in time to the 4th of November 2019, before the iron ore ridge was producing or mining iron ore. Now, this is a feasibility study that Fenix did release on this particular date. And these feasibility studies are really important because we can get some information about the mine and what the company thinks about the mine in terms of mine life, in terms of net present value, in terms of capital expenditure, in terms of estimated C1 cash operating cost, and in terms of project net cash flow. So on this particular date, they expected initial capital expenditure of less than $12 million and an average annual EBITDA of more than $16 million. They also expected, well, the initial mine life, maybe it's not expected, but the initial mine life was 77 months, which in terms of years is divide that by years. So we're talking about between about 6 and 7 years. So say 6.5 years. So Iron Ridge mine life is 6.5 years. The average C1 cash cost estimated to be about 77 Australian dollars. The project net cash flow, 110.4 million Australian dollars. Mine revenue, $802.9 million. Net present value, only $54.3 million. So it does look like some of these estimates might have been on the low side when you look at the cash flow this company has generated over the past 2 years since the mine has been in production. So some of the assumptions the company might have used was a lower iron ore price. So if the iron ore price remains really elevated, a lot of these numbers were going to be much better than expected. The other thing I hope in regards to Fenix is they extend the mine life. We have seen this a lot for mining companies. The mining life of a project can be extended quite often, and it can be extended from, say, 6.5 years to 15 or even 20 years. So hopefully that happens for Fenix in the next few years. They can extend the mine life from 77 months to maybe 100 months, maybe 110 months. So that is one thing I'll be looking forward to for Fenix in the next few years. Another thing I look for in mining companies is mineral resources. And you could also look at reserves as well, but I'll just show you resources. I'm comparing the mineral resources of Fenix Iron Ore Ridge project before they started mining. So this was from 21st of August 2019 to current mineral resources. So before they started mining, they had 10.5 million tons, and right now that is down to 8.3 million tons. You also can compare it year on year just to see how much they have decreased their resources in the past year. So it's very important, in my opinion, to look at mineral resources, even look at reserves on an ongoing basis for every single mining company you might be interested in or am a shareholder of. Now onto the valuation metrics for Fenix, and this will be highly important if I considered Fenix to be a high quality company. For high quality company, it's all about value and whether I see value. And if I thought this company was high quality and I saw a P ratio of 2.8, if I saw enterprise value to free cash flow of 0.74, I would be selling my house. I would be going into $20 million of debt right now to buy all the shares I can of Fenix Resources, because if I thought this company was high quality and I saw these sort of valuation metrics, either something's really amiss, probably should mention that as well, there could be something seriously wrong with this business, or I thought this would be the buy of the century, the millennia. Now for kicks, I also did a reverse DCF. So what would the cash flow have to do over the next 10 years to justify the current valuation? And I get a negative 23.4%, which sort of makes sense because the mine life only has about 5 years to go, maybe even less than 5 years. So from 5 years, 5 to 10, this company should be producing zero cash flow based off where they are right now. So this could be true. This could be right. Negative cash flow over the next 10 years of negative 23.4%. And that is one of the reasons why I think the market is giving a little bit of a discount to Fenix right now, because the mine life is fairly limited in terms of years. So it's only about 5 years left in the mine life. And that's sort of regardless of any extension to the mine life the company might make over the next few years. Now to something really interesting I saw with Fenix Resources when they went ex-dividend in September this year. For the month leading up to the ex-dividend date, we saw a run in Fenix share price. In fact, the share price went from 27.5 cents to 37 cents, even though iron ore prices were dropping. So there was sort of a disconnect, well, not sort of, there was a definite disconnect between Fenix share price and iron ore prices. And no doubt there were some income-driven investors who saw that the dividend yield this company would be providing, and they were buying no matter what was happening with the iron ore prices. And then when the company went ex-dividend, the share price dropped from about 36.5 cents down to about 25 cents in 3 trading days. And then it kept on dropping as iron ore prices dropped. But recently we have seen a run up in iron ore prices, and we're starting to see the share price of Fenix starting to climb as well. And I think there is potential in September next year, we'll see the same thing. No matter what iron ore prices are doing, we will probably see Fenix share price go on a run, particularly if they continue giving their shareholders back a 5.3 cent dividend, or even a higher dividend, particularly if they produce more cash flow in the next year. So a thought I had was maybe sell out of my Fenix shares if I see the same thing just before they go ex-dividend, and then buy back in a few days later to take advantage of that significant depreciation in the share price. So even though the dividend was 5.3 cents, the share price of Fenix dropped about 10 to 11 cents in 3 trading days, which is significantly higher than the dividend. The next 5 companies I'll be featuring in this particular Kneppy's analysis video series include SG Fleet, Brambles, 9 Entertainment, Premium Investments, which is a request from a viewer, and the next video we'll be doing is on Laser Bond, which is a small cap company, a profitable small cap company on the ASX. I have been a shareholder of this company in the past, and even though I'm not a shareholder right now, I am following that company quite closely because I like what they're doing, and I think they have the potential to be significantly bigger in the next 5, 10, 15 years. So I might be planning on taking a position in Laser Bond in the near future. That's all I have for this first video on Kneppy's analysis, looking at Fenix. If you have any questions about this company, any questions about iron ore, if you think I'm absolutely crazy to be owning shares in this company, if you think I'm totally crazy to think this is a low quality company, I'd like to hear your opinion, because as investors, as human beings, we learn from listening to others' opinions, listening to different opinions. That's how we grow. That's how we become better investors and better human beings. So if you do have a different opinion than my own, I'd love to hear it. So just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.